You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-exciting, at least we hope so, Options Insider Radio Network. If we sound a little bit different, it's because we're not coming to you from our studio in Chicago. No, we're coming to you from the scenic and sunny Options Industry Conference here in Miami, Florida. We've got a great slate of guests lined up for you, including our next guest, Greg Ferrari, the head of options over there at Nasdaq. Greg, welcome to the Options Insider Radio program.
Good morning, Mark, and thank you. Glad to be here.
And Greg, as we are wont to do with all of our first-timers here, why don't you go ahead and give our audience a little bit of an overview of your background in the space and how you found your way to becoming the head of options over there at Nasdaq.
Sure. So I've been in the business 21 years. I spent the first 10 years of my career on the sell side. Started at Credit Suisse, through Lehman, on to Bank of America Securities, in a variety of roles in touching financial trading technology and across equities and fixed income. Moved over to the ISE in 2008, spent 3 years there in a business development capacity. In 2011, I moved to Nasdaq and was in a cross-asset business development function between equities and options. And about 2 years later, I solely focused on the U.S. options markets, our market participants, our business strategy, our pricing, et cetera. And then came full circle. Nasdaq in 2016 made a strategic investment or M&A on purchasing the ISE, and lo and behold, here we are operating 6 exchanges.
And I assume you never heard us before, but with a name like Ferrari, I'm assuming you're a classic car aficionado, correct?
But of course, obviously, then speed kills in options trading, so it comes together.
We're here at the options conference. You just got off the exchange leaders panel. Actually, I'm curious. What were any interesting takeaways from that session? I know it changes every year with the topic. What were some of the hot topics this year?
There was a myriad of topics. Some things new with respect to how exchanges approach new products, and not everything is going to have success overnight, and what is needed. So yesterday, MIAX announced a partnership with the Minneapolis Futures Exchange for launch of the Spikes Futures. So it engaged a vibrant discussion around what's needed in the volatility space and the ability to have the appropriate support and the ecosystem to build new products. We've launched a Nasdaq 100 product that's 1/5 the size of the traditional big NDX. Obviously we've been in a secular bull market for north of a decade, so the Nasdaq 100 notionally has gotten pretty large. So we felt compelled, and the marketplace felt the need for a smaller notional contract. So we talked about supporting that, getting the liquidity side, investor education. The prolific use of or growth of fixed income ETFs is something that we touched on. So you've got your rates, credit, and commodity products that are finding their way to our marketplace, and I think that's really important for our growth.
And you mentioned new vol products. You guys have some skin in that game. The last time I chatted with you guys was a year ago. It was with your predecessor, Kevin, and he was very excited about what were known then as VolDex and SkewDex, and he made it sound like they were imminent, and we were all looking forward to them. Here we are a year later, and they still haven't listed. So catch us up. A lot of people you just talked about spikes. A lot of people are excited about new products in the vol space. What do you have for them, Greg?
So I mentioned spikes because they actually have options on them. We have an index, so this is in partnership with Scott Nations. The VolDex methodology traditionally was on SPY options was the basis for the Vol-E product, which ISE had approval for, but we were looking for the right partner to list futures on them. So inherently, we decided that launching the options without the future was a path that we did not feel comfortable with, because the liquidity providers did not have the natural hedge to insert themselves appropriately. So with that, we also have some headwinds on the backs of the volatility events from February in terms of final settlement and associations with specific ETP products and how they impact volatility in VIX in particular. So with that, we've decided to pivot away from Vol-E as a product, and now, as of January of this year, launched the Vol-Q index. Hence, the last letter in that ticker is the association with the Nasdaq 100 as Q. So we've been ticking for about 3 months, pumped out through the Nasdaq index dissemination service. We are actively engaged with the SEC about options on Vol-Q. And we actually have an agreement with CME to list Vol-Q futures, which we are hopeful will be at the end of this year.
And is it the same methodology as effectively the old Vol-Dex?
It's an identical methodology,
okay,
but we're using an additional 12 strikes for settlement.
Okay.
Probably when Kevin spoke to, was only using 4 out of the money puts. So now we're
Why would
up to
anyone
16.
want to improve their settlement in the volatility space? I have no idea why someone would
some
be.
boo birds tell me it's what's needed.
Is it fair to say the regulators have taken a second look at everything volatility related post Febocalypse, shall we say?
Yeah, I think any new product, the regulator wants to be heavily involved in terms of understanding its nature, sort of the balance between the demand and supply side, and then how final settlement can be manipulated is something that is of top mind of the regulator and of the exchange and of the index provider. So collectively, we all want a good product so that investors feel confident and want to be able to represent their views in a meaningful and transparent way.
Well, we are at an industry conference, predominantly an exchange conference. There are now 16 of them. You mentioned MIAX earlier. They added the 16th to 3rd to their stable. You guys have, 6 now? So you have quite a few. I'm assuming you're happy with your allotment of 6, or are there other plans for more Nasdaq? You're going to go to 7 anytime soon?
At the moment, no. We have no plans for a 7th. I think we are struggling to find the appropriate use cases today of numbers 5 and 6. So, when we purchased ISE, and they had just launched the Mercury Exchange, so they only had 6 weeks of life under that management to be able to figure out what to do with that medallion. What we've done, we've identified specific, allocation models and different pricing models to be able to covet different segments of flow. Mercury and BX do have challenges in terms of internal cannibalization, if you will, right? In terms of pulling from ISE, PHLX, NOM, or Gemini. So it becomes somewhat of a challenge to be able to figure out how to identify specifically with those market models. What we believe is the new sort of upstart wholesalers, the new liquidity providers, have a pretty good experience on those markets because it's less crowded. But order flow is traditionally in the hands of few, and they're trying to manage to their appropriate programs that are traditionally done on the larger exchanges.
And you mentioned kind of the pricing model. It does seem like most of these, they're termed exchanges, but really, you're right. They're kind of variations on pricing for the most part, right? A lot of them, particularly under the same groups, are usually the same technology, just a different fee methodology for the most part.
And allocation. So with BX, we have it was married off of the NOM code structure and the NOM rule set. So we have the ability to change any symbol to be whether it's price time or pro rata with a specialist. But one of the nuances of that market model is that we don't have a preferenced order type, if you will. So where an order flow provider can preference a market maker and generate PFOF, that we support that on the 3 of our ISE exchanges and on PHLX, that functionality. On BX, what we tried to do is come up with what we call transparent model for payment, where it's the exchange is the bilateral party with the order flow provider. And the model had success in 2013 through, I'd say, 2017, and now has struggled in the last 2 years. And I'd say that's as a result of the consolidation of market makers that are just not on that quote as aggressively as they were.
Let's talk about the market makers too, because that's another hot topic here. And for a lot of people coming through the studio over the past few days, it certainly has been, and it's a big one continuously at this conference. As you mentioned, there are, it's not exactly a class of the industry that is thriving. There are not new market makers flooding into the space year over year. It seems like there's fewer year after year. There's a lot of pressures on that space from a technology perspective, cost, risk, all these other things. I'm curious, what do you think? You guys obviously have a lot of stake in the game with 6 exchanges. What do you think we could do as industry to maybe try to lighten that burden? Maybe, who knows, maybe even incentivize new firms to come into the space. It's interesting when we have market makers in here telling us, hey, we want more competitors, bring more people into the space. That's usually an interesting commentary.
So Nasdaq's listening to those same guys. One of the things that we're actually seeing some growth, actually. So there's definitely new players in the space, seeing the activity in 2018 and the edge capture profile being somewhat positive for those that were in the business. Firms have taken a look hard here and saying, like, what can I do to enter the space? So we have a very robust equity market. Obviously, there's a lot of different liquidity providers in that space and the ETF space that are talking to us about options. So we are having those conversations. I feel pretty good about certain firms that are willing to make that investment. I don't think it's an industry challenge in terms of liquidity. I think it's the market structure has been somewhat ripe for this dislocation, if you will, and that's very, very difficult. I think Nasdaq is trying to make it as easy as possible for our clients between common APIs, common data feeds, and a simplified offering within our data center to be able to onboard newer entrants. But we agree that it is not a low bar. It is a medium to high bar to be able to excel in this business, and you need to be on at least R6, I'll say. Whether you want to be on the other 10 is a whole other story, and go from there.
We always ask our audience when we come down here, what kind of questions would you like us to put to the industry? And particularly this time of year, earnings season one seems to resonate with a large core of the audience, particularly a lot of the retail audience, which is, they can go out there right now during earnings season. They could buy their shares of Amazon and Google, whatever it might be, and they could trade it during the day. They could close out after hours if they want. And they still can't do that with the options component, obviously. So the obvious question they're always asking us is, why can't I do after-hours options trading? So, Greg, as the keeper of 6 exchanges, I put it to you, sir. Why can't they trade options after hours?
I'd say 2 reasons. One, we are challenged as an industry with the number of series, as over 990,000 series available. And if we believe that we have a liquidity challenge in names, 50 and onward, the ability to facilitate transfer of risk in the after-hours market when the actual underlying market is not really that robust in terms of liquidity, to then have a derivative market that's available as well, side by side, to trade options on earnings. We like the fact that if it were to expand, that obviously the use of auctions actually could be very helpful here in terms of what should the experience for a retail or institutional investor be in a post-earnings event as news comes out to the market and investors synthesize that information to be able to make an informed decision about whether they want to roll that position, exit that position, enter a new position, et cetera, with the new information. With that, I think there will be some operational challenges from a clearinghouse to be able to support. We have a 5:30 p.m. cutoff right now in terms of next day settlement to be able to make post-trade allocation changes. If we do create this follow the sun model, then we would essentially be open 24 hours. Ameritrade made an announcement for the ETFs in Asia and has had some mild success trading the ETFs. So if we were to move forward, I'd love to see that happen in the ETF space as opposed to the single stock space.
Oh, so you don't think like maybe a pilot around earnings season would be a way to maybe get some interest in that? Like, Amazon, during your Amazon or that week, maybe we have some interest, then you rotate that. You rather have it on a broad-based ETF?
I'd say because the SEC has pilot fatigue at the moment, the SEC having pilot fatigue really would introduce some challenges of what we're trying to do with them and try to right size sort of the appropriate challenges in our market. What I would say is it could be interesting. I think we look at it. Our retail firms are not suggesting that that's an area that they need for us to expand on. But we would absolutely introduce it if that's something that they believe that their clients have an appetite for.
You mentioned auctions earlier before, Greg, and I kind of want to go back to that because that's a bit of a contentious topic. We have I'd say a fairly even split among the people who come through here, and whether they're pro or con on the auction side. The pro people think, they're great. They show off tight markets and people like it and they give people price improvement. People who are against it say they hide liquidity and they fragment the market and they give people the illusion of price improvement without real price improvement. You have a variety of exchanges. They have a variety of offerings. I'm curious, where do you, as you look at the industry, what do you come down on auctions?
I think they have an end benefit that, if used properly, does provide the end user with, the effective spread that they're paying is diminished significantly. So that there's significant benefits associated with the products. Sort of the opportunity cost that was lost is sort of the quoted market maker that's out there that they're contributing to lit price discovery. Is not being valued in this market in terms of what their role is. So if an order flow provider has the ability to match that displayed quotation and get 40%, it has diminished the value of that quoted market maker who does not have order flow relationships, which I think is one of the contributions to some of the challenges that the mid-tier market maker is facing. They've had to adapt and invest in technology to, interact in complex order books or respond to auctions or utilize the price time make take exchanges to face these headwinds of the shift in where order flow has ended up. I should add also in contributing into flash auctions. There's a multitude of things in where order flow has shifted, and the auction has contributed to some of the deterioration in the lower price names.
You think we're heading away from auctions anytime soon, or it seems everyone has them, everyone has some variation on them. It seems like they're kind of here to stay. But do you see that does seem like it seems to be a more increasingly prevalent viewpoint? Do you think there's anything in place to really start dialing that back?
If we dial back, it would have to be widespread across all of the exchanges. It can't be one exchange saying, "Hey, I want to make a change." And because order flow would leave the exchange, and we are for-profit companies, and we value our partners and the order flow that they provide to our exchange. So if we are going to take a sweeping change to market policy, it would have to be across the board. There is a listed option market working group for market structure, and this is one of the subgroups that is focused on lit market quality. There is no smoking gun here, if you will, in terms of what problem the industry is trying to solve. And coming off of a record 5.2 billion contracts in 2018, I think there's slightly less appetite to take on a project and challenge to fix a market that had a record year in volume, quite frankly. So I'd say it's here to stay, but we look in the back of our minds and put it on the back burner, so to speak, of whether this is something that we want to fix now or fix later.
And you mentioned market quality earlier, and you also mentioned earlier the strike mitigation. That seems to be the movement, the initiative, if you will, that has the most backing behind it in terms of trying to look at the broad array of strikes that are out there and maybe trying to take some of those off the table. Is that something you guys are investigating over there and supporting at Nasdaq?
We are. So the industry has evaluated a couple of different threads. One that has gone extremely well in terms of harmonization is the change to the authorized give-up policy. So from a clearing firm risk perspective and how their capital is allocated, having unfiltered access is something that we as an industry have agreed to and have rulemaking in place, and that is something that we've taken a lead on as Nasdaq, and other exchanges have followed suit, and we're really excited about that. So the other threads have more work to do to get to that level that authorized give-up did. Strike listing / delisting, if you will. We're looking at it as a strike density problem as an industry. And there's a proposal out there. It's not hardened yet. The industry needs more time to digest that and to determine the appropriate outcome. You have a multitude of factors to consider. One being whether an exchange can have let's just use an option that's $2.50 and if another exchange has the $2 and the $3 on a 50-cent wide spread, what would that experience be if for the end user who wants to do, a credit or debit spread, and whether those exchanges can or can't list them because it has the 250s. So what is the experience for the user being consistent? What is the experience for the wholesaler and where they bring it? Because not all features and functions exist on the same marketplace. So we want to make sure that A, the end user has that consistent experience to do the roll, and then B, from a strike density perspective, that the marketplace does not need a multitude of strikes, typically in the weeklies, as we come closer to expiration. 5 delta and below and 95 delta and above, where there's an abundance of choice that is essentially seems obtuse, if you will.
I like that. Obtuse strike selection. That's a good word for it. Well, Greg, we covered a lot of different areas here in the space, but before we go, we like to leave our audience maybe with a little bit of a hint, a little bit of a tease of something they could look forward to coming down the pike from Nasdaq, sir. So now is the time. The floor is yours.
So less of a tease, but maybe better for your audience, is that we're launching our third complex order book on Mercury, our smallest exchange. That will be live on June 24th. It will have the same features and functions of the IC complex order book. We'll price it slightly differently to attract a different segment of the market. We are working with the marketplace to determine the optimal fee determination for how to attract liquidity in the spread book and attract order flow to the spread book. But we're really excited about that, and can't wait to report maybe next year how we did. Yeah, we're looking forward to that and how VolQ and everything else unfolds in the market. What was you said September you thought was the launch date for the volatility product? On the futures itself, we think by year end, CME has their micro futures that they're looking to put up first, and then the VolQ futures as a next. Great. Well, we'll look forward to that and look forward to seeing how all these initiatives unfold in the marketplace in the coming months, Greg. Thank you.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.